When markets become chaotic, something powerful happens inside the mind of a trader. Charts begin moving rapidly, prices rise and fall aggressively, news headlines become dramatic, volatility increases, and suddenly the market environment feels very different from normal days. Many traders describe this experience as stressful. Some feel anxious, some feel overwhelmed, some feel pressure to act quickly. In these moments, the biggest challenge is not technical analysis. It is emotional stability, because market chaos tests the trader's mind more than the trader's strategy. In this video, we are going to talk about something extremely important: how to manage stress and anxiety during market chaos. Because when markets become unstable, your emotional reactions can become stronger than your logic. Fear can appear quickly. Anxiety can affect decision-making. And if traders do not understand how to manage these emotions, they can make impulsive decisions that damage their trading performance. If you stay with me until the end of this video, you will understand why market chaos creates stress, how professional traders manage psychological pressure, and what mental habits help traders remain calm during the most uncertain market conditions. And if you want to build strong emotional discipline as a trader, consider subscribing to Bull Mindset. This channel focuses on trading psychology, discipline, and the mindset required to survive and succeed in financial markets. Now let us begin with something very important. Market chaos is not unusual. Financial markets go through cycles of calm and cycles of volatility. Sometimes markets move slowly and predictably. Other times they move quickly and unpredictably. Market chaos usually appears when uncertainty increases. Economic data surprises investors. Interest rate decisions shock the market. Geopolitical tensions create fear. Unexpected events affect global confidence. When these situations happen, investors begin reacting quickly. Large institutions adjust positions, liquidity changes, and price movements become larger. For traders, this environment can feel uncomfortable because the mind prefers stability. The mind prefers predictable patterns. But chaotic markets remove that comfort. And when predictability disappears, stress increases. Let us talk about why this happens. The human brain is designed to detect threats. When something appears uncertain or dangerous, the brain activates a stress response. Heart rate increases, breathing becomes faster, attention becomes focused on potential danger. This response helped humans survive in dangerous environments throughout history. But in trading, this same response can create problems because stress can interfere with logical thinking. When stress increases, the brain prioritizes quick reactions instead of careful analysis. This is why traders sometimes make impulsive decisions during volatile markets. They may close trades too early. They may enter trades impulsively. They may increase position sizes out of frustration. And after the situation stabilizes, they often realize those decisions were emotional rather than strategic. Now let us talk about anxiety. Stress and anxiety are closely related, but they are slightly different. Stress is often a reaction to immediate pressure. Anxiety is the fear of what might happen next. In chaotic markets, traders often experience both. They feel stress because prices are moving quickly. They feel anxiety because they do not know what will happen next. This uncertainty can create constant mental tension. Some traders begin checking charts every few seconds. Some traders begin imagining worst-case scenarios. Some traders feel pressure to act even when no clear opportunity exists. But professional traders approach market chaos differently. They do not expect markets to remain calm forever. They understand that volatility is part of the trading environment, and because they expect these conditions, they prepare their mindset in advance. Let us talk about how experienced traders think during chaotic markets. First, they slow down. When markets move fast, many traders try to react faster. But professionals do the opposite. They slow their thinking. They take time to observe the market structure. They avoid making decisions in moments of emotional intensity. Second, they focus on risk management. During chaotic markets, price swings become larger. Professional traders respect this change in conditions. They may reduce position size. They may trade less frequently. They may avoid certain setups until volatility stabilizes. These actions are not signs of fear. They are signs of discipline. Third, they separate emotions from decisions. Professional traders understand that emotional reactions are normal, but they do not allow emotions to control their behavior. Instead, they rely on predefined rules. These rules act like a guide during uncertain situations. Now let us move into real trading examples. Imagine a trader watching the market during a highly volatile day. Prices move aggressively up and down. The trader enters a position. Within minutes, the trade moves against them. Stress appears immediately. The trader begins thinking about closing the position quickly, but the stop-loss level has not been reached. The trading plan still supports the trade. If the trader reacts emotionally, they might close the trade early. Later, the market might move in the original direction. Now imagine another trader in the same situation. This trader feels the same emotional pressure, but instead of reacting immediately, they check their plan. They remind themselves that volatility is part of the market. They follow their predefined rules. Sometimes the trade works, sometimes the stop loss is reached. But the key point is discipline. Now let us consider another example. A trader experiences several losing trades during a chaotic market. Stress increases. The trader feels frustration. They want to recover losses quickly. This emotional state can lead to revenge trading. Instead of waiting for proper setups, the trader begins forcing trades. Position sizes increase. Risk management disappears. This behavior often leads to larger losses. Professional traders recognize this psychological trap. When they feel frustration building, they step away from the market. They take a break. They allow their emotions to calm down before making new decisions. Now let us talk about mental frameworks that help traders manage stress and anxiety. The first framework is acceptance. Chaotic markets are part of trading. Trying to force the market to behave calmly creates frustration. Accepting volatility reduces emotional resistance. The second framework is process focus. Instead of focusing on profit or loss, professional traders focus on execution. Did I follow my plan? Did I manage risk correctly? Did I remain disciplined? This mindset shifts attention away from emotional outcomes. The third framework is long-term thinking. Trading success is not defined by a single day of market chaos. It is defined by consistency over many trades and many months. Professional traders maintain this perspective. Now let us discuss practical exercises that can help traders reduce stress. One simple exercise is breathing control. When stress increases, breathing becomes shallow. This physical response increases anxiety. Slow breathing can calm the nervous system. Taking several deep breaths before making a decision can restore mental clarity. Another exercise is creating distance from the screen. Watching every tick during chaotic markets can increase emotional tension. Stepping away for a few minutes can help reset the mind. Professional traders understand that mental clarity is more valuable than constant screen time. Another helpful exercise is journaling. Writing down thoughts and emotions after trading sessions helps traders recognize patterns in their behavior. Over time, this awareness strengthens emotional control. If this video is helping you understand how to manage stress during volatile markets, consider subscribing to Bull Mindset, because developing strong trading psychology is one of the most important skills for long-term success. Now let us move toward the final idea: control. Traders cannot control market chaos. They cannot control global events. They cannot control economic surprises, but they can control their behavior. They can control their discipline. They can control their risk management, and they can control their mindset. This control is what separates emotional traders from professional traders. Let me leave you with one final thought. Market chaos does not destroy traders. Uncontrolled emotions do. Stress can push traders to exit too early. Anxiety can push traders to make impulsive decisions. Frustration can push traders to break their rules. But calm thinking changes everything. When traders learn to manage stress, they can observe the market clearly. They can follow their strategy. They can protect their capital. And they can allow probability to work over time. The strongest traders are not the ones who avoid stressful markets. They are the ones who remain calm when markets become chaotic. Stay patient, stay disciplined, and remember that the most powerful edge in trading is emotional control. And if you want to continue strengthening your trading mindset, subscribe to Bull Mindset. I will see you in the next video.